Today we'll be talking about inventory turnover ratio. Why do we even need to have inventory in the first place? Well, the reason we have inventory is to keep from having empty shelves. We don't want to be stocked out of our goods. When customers come and they see empty shelves, that is bad for business because when they come into your store or your place of business and there is nothing for sale, they're more than likely to work out. And when they walk out, they might never come back. So we do not want to be in a situation where inventory is gone or almost done with. So we always want to have sufficient inventory, but the trick is just keeping just enough on hand without having excess. So why don't we want to have too much inventory? Well, there's a downside. There's a cost to holding inventory. For example, when you hold too much inventory, there's a labor cost of just keeping track of everything. The counting the inventory, making sure the stuff, moving inventory around, rearranging things. There's a handling cost. So those are things you have to keep in mind. The more inventory you have, the more labor you need to maintain it. What about storage space? The more inventory you have, the bigger the space you need to store your excess inventory. Then there's insurance of insuring the extra inventory you have on hand. And then plus there's a risk that your product might no longer be needed in the market. So it's going to become obsolete. And that means nobody wants it, which means you're going to have to mark it down and sell it for a very low price. And then what about the opportunity cost of capital? Your money could be better used someplace else. So you do not want to keep too much inventory in hand because the longer you keep your inventory in hand, the higher your cost is. Now let's move our attention to the inventory turnover ratio. What is the inventory turnover ratio? It computes how many times inventory is sold within the period calculated. For example, if I'm calculated within a year, then it will compute how many times my inventory turns over within that year, so which would be like 365 days. It's computed by dividing cost of goods sold by the average inventory. We will see an example later. The higher the ratio, the faster inventory moves. In an ideal situation, we do not want to see inventory just sitting around. We want inventory moving as quickly as possible. Now, let us take a look at an example of how to compute inventory turnover ratio. To do that, you will need what we call the profit and loss statement and the balance sheet statement. It is recommended you have at least 2 years of inventory because that helps us smooth out the variation of the data. So to do that, look in the profit and loss statement for the cost of goods sold. In this case, we have 1,281,000. Get the average of the last 2 years, which is the 500,000 and 450,000. When we divide 1,281,000 to the average of 500,000 to 450,000, we'll get 10 times. So which means inventory is turning over every 10 times. However, to make it easier for us to translate what this means, it's easier for us to compute that into number of days. To do that, we divide the 10 times by 365 days, which means that inventory is turning over every 36 days. So which means every 36 days, we're completely selling that inventory. Whether this is good or bad depends on the business and the industry the business is working in. The inventory turnover ratio works hand in hand with the accounts receivable turnover and in days sales outstanding and days payable outstanding. If you're selling inventory pretty fast and collecting very fast and paying slow, then cash flow wise, you will be fine. So here we're going to see an example of how it works hand in hand with the days sales outstanding and days payable outstanding to affect the working capital, whether you have a cash shortage or surplus. So like let's say in this situation, um, using the same financial statements we've used in the previous example, if this company has no accounts receivable, we see here they have no cash flow problems. Cash flow is positive. The problem comes when accounts receivable is not being collected. That's when, oh, maybe, and then they have maybe they're selling only 40% of their sales of cash sales, and so now we have problems with accounts receivable. So now we can see we have a problem with cash when we start manipulating that because now we now have accounts receivable and then we're not collecting, our daily sales are standing 33 days. So which means now we're having cash flow problems because we're selling, even though we're turnover ratio relatively okay, but we're not collecting fast. So again, that gives us a cash flow problem. So with the day sales outstanding, you want to make sure that you work hand in hand with your payable outstanding and inventory outstanding, just to make sure that you're collecting as quickly as you turn over your inventory. Because if you're turning over fast and you're not collecting fast, that is a problem. So you really need to be careful about not just trying to sell your products as fast as possible. Yes, accounts receivable can help you increase sales, but you want to make sure that you do it in a way that it's not affecting your cash flow problems where you're always having to go to the bank to meet that shortage. If you really want to delve deeply into your business and get very good insight, I recommend you get the workbook and exercises by clicking on the link below. In this exercise and workbook, we delve very deep into your business to see what the numbers in your business really mean. Because sometimes as business owners, we run our business and we don't really understand what our financial director is telling us or what changes we need to make. With the workbook and exercises, you'll be able to really delving into what is making you profitable, why, what do I need to change, and my policies make sense, they make sense for my specific business. And not only that, you get internal process analysis, like what areas in your business are you spending too much, or where can cost be delivered at less cost, where can processes be delivered at less cost. Using the information from 1 and 2, you can use that and create a 5-year budget so you can actually start being on track to direct your business rather than letting the wind blow you wherever the business takes you. So you're being proactive rather than being reactive.